Hi, I'm Lisa Kirschenbauer, founder and president of Omega Wealth Management, and we're back with Bridging the Gap. Joined, as always, is my compatriot, Jared Jones, Director of Investments and Lead Advisor for Omega. How are you doing today?
Doing well. We're in fall now, so that's a good feeling. It's getting cooler. Walking to work now, so it's
Good
nice
for
weather.
you.
Yeah.
Fantastic. Well, I love doing these Bridging the Gap sessions because I think it's a chance for us to share different perspectives, both about money, about the markets, and even life. And whether it's the lens of gender or generation, or right now, hot topic, political orientation, we hope to inform you, educate you, and hopefully entertain you a little bit. So we've really got two topics that we're going to talk about today. One is whether inflation is back. And there's some growing news stories around, it depends on where you look. Is inflation back? Is it not? And as we've just started to wrap up the third quarter and we're looking at how the markets performed, I think the story, it's important to understand what's really going on with the markets and where are returns really for year to date, especially as you start to look at your performance for the quarter and so far this year. So that's where we're going to focus. Jared, you want to lead us off a little bit about this whole inflation topic?
Yeah, so there was an article, I think, earlier in the Wall Street Journal that indicated maybe we've seen some inflation starting to pick up. If you go to the grocery store recently, I know we're starting to see that just on our personal house. Some of the items that we usually pick up from the store are going up in price. So they highlighted some of that. They talked about the Fed. In an earlier episode of Bridging the Gap, we covered that the Fed had made a huge transition. At the time, it didn't seem like it was a big shift, but it actually is. They're no longer going to be focusing on inflation for what to do with interest rates. So if we do start to see a pickup in inflation, which if you read any economic textbook, it'll tell you in situations like this, when the monetary and fiscal stimulus comes and there's more money sloshing around, liquidity is everywhere in the market right now, that's a textbook reason why you would see inflation. The Fed actually, I think, had been using models based on unemployment. If unemployment dipped below a certain point, that's another, it's called the Phillips curve. If anybody's curious out there, if unemployment dipped below a certain point, that would also be an indicator for when inflation would pick up. The models had been broken for a long time previously. We had seen that before the coronavirus. Inflation was struggling to hit 2%, and then unemployment was at historic lows. So inflation has kind of been a mystery for a lot of people of what's going to cause inflation to pick up. So I think right now we're definitely seeing some of it. The Fed uses, you're going to have to jump in here because we were just talking about this. It escaped my mind.
It's the PCE, the Personal Consumption Expenditures Price Index, but that's not the one we hear about all the time, is it?
Yeah, no. We always see CPI, Consumer Price Index. That's the one that gets reported in the news. I know the Fed's their index looks at what they think is an average basket of goods and services. It's more heavily tilted towards services, I believe, at this point, but it focuses on prices of those goods and services to see if there's any inflation. So we're starting to see a pick up. And we were talking a little bit beforehand, didn't want to get too deep because this is what we want to talk about on the show. But I'm not convinced this is a long-term, it might just be a blip on the radar. I'm not convinced it's a long-term switch that we're going to have inflation all of a sudden.
Yeah, I mean, I hear you on that. I think my concern is, okay, that may be true, but in the meantime, you have a lot of people who are still unemployed, and those same people who are unemployed are having to pay more for, basic types of things, the price of bicycles and going to the grocery store has gotten more expensive. And I know the Fed is sensitive to this because, some of what they're trying to do with their policies going forward is to try to help, obviously get people back employed, but a broader group of people employed. But in the meantime, there's only so much they can do. They're not superhuman. And so we have this phenomenon where, basic services, I know I get my nails done. I, do some of that personal care stuff. And every one of those places I go, there's an upcharge. And then there's, going to the grocery store. Things like, books and recreational books and things like that, they all cost more now. So I'm a little concerned. It may not be a long-term trend. If you get people back to work, then maybe it changes. The other thing that's interesting that I think we haven't even fully factored in is when the government put all this stimulus out, people did spend some of that money. And that was part of why I think our consumer spending numbers looked better. Obviously, it was pretty focused in certain places where you could spend it, right? You couldn't spend it on airlines, but you could spend it on, getting takeout. And so now that stimulus has gone away and it doesn't seem that Congress is going to be able to figure this out, I'm interested to see what happens. So you have, people still need to go to the grocery store, but prices have gotten more expensive. So how does this all play out? Is it, probably not a long-term phenomenon, but what's important is that, the Fed is very focused on employment and inflation. So what are they going to do if they can see prices are going up, maybe not on their index, but on the other index? Do they do something about that? I don't know how much more they can do.
Well, I think the Fed, Jerome Powell, has recently gone on a speaking circuit, more or less in the last few weeks, saying, they're not out of ammunition by any means. There's really, I don't think there's a limit on what they can do, but they're not going to be able to get money. They can lend, but they can't spend. That's his tagline that he's been saying. So we need Congress to step up really to help get the spending going for consumers. So I think that's the main hurdle to jump through in the near term. In the long term, if you want to take an oversimplified look at inflation, it's when supply can't keep up with demand. So there's an excess of demand in the market, supply is limited. So that might be kind of the answer to some of these increases. There was problems with supply chains due to the coronavirus earlier on. I don't know if we're still seeing some of that. Hard to say. But with unemployment still being so high, I personally don't know if there's an excess supply of labor in the markets right now. There's not enough jobs out there for the supply in the labor market. And until we see that go down, I would be hesitant to say that it's a long-term trend up. I think if we are to see inflation, it's probably going to be 4 or 5 years down the road after all of this is said and done.
Well, and just to mix it up even further is a lot of people have concerns about the amount of debt that our country has, and they're concerned that somehow that's going to be inflationary. So, it's hard to know where to look. Maybe not the normal places for inflation right now, but it's something that, we certainly need to keep an eye out for. Although we know that certainly being in equities, being in stocks is your best bet to keep pace with inflation. So, what makes that even trickier is you're worried about where the markets are going. You step away from equities. How are you going to keep pace with inflation? So lots to think about here, and to be careful about. And, and that's part of our job when we're working with our clients, is to look at all of those different sides of it, not just one side, not just the elections, not just inflation, not just returns in one particular place, which is the other topic we wanted to talk about today. So something to watch. And maybe next time when you're listening to hearing, the figures for the month, is it CPI or is it the PCE? So I think hopefully we've given everybody a little bit of learning on that today.
Yeah, maybe we can provide some links for people just to check out what's included in each of those indexes in the show notes here.
Yeah, that'd be great. Nice. So we've just begun to wrap up Q3, and people are going to start to get their statements and get their performance reports. And, I think I've been feeling very strongly as we're talking with clients about giving them the real picture of what's going on with the financial markets this year. Because if you just listen to the headlines every day, maybe, you caught the news, or, you listen to Marketplace or whatever, and the market's up and it's back up, at least the Dow Jones is, at 27, 28,000. And I'm not sure where the S&P is, but it sounds like, wow, we're booming, right? And that's not really the true story, because what really has happened is that we started the year, maybe went up a little bit, took a big nosedive February to March, have had an amazing V-shaped recovery, as we hear about in the markets. In the markets, we've had a V-shaped recovery. But all that's done is taken us back to about where we were at the beginning of the year, depending on how you're invested, right? So we know that the numbers look a lot different than people may think.
Yeah, absolutely. I think, it's a little, when you see the numbers reported on the news, you usually see the Dow Jones. That's usually the one that people focus on. You might see the S&P 500, and you might see the NASDAQ as well, but most people tend to focus on the Dow. So for the Dow and the S&P, I think it's worth talking about how those are calculated. So the Dow is a price-weighted index. So they actually, the proportion of the company that makes up the index is dependent on the price of the stock. And then they divide all of the market, the prices of all the companies that make up the Dow by a factor. And that factor, it's actually printed in the Wall Street Journal. If you get it, it's somewhere in like the page 2 or 3 area. It's really small. It's a crazy number because it's been adjusted for inflation over the last however many years the Dow has been around. But that's interesting. And then the S&P 500 is a market cap index. So it depends on how many outstanding shares a company has and the price of those shares. So that's a really long way of me saying that the Dow and the S&P are being dominated by stocks right now that are A, expensive, and B, huge. So the easy places to look at are the FANG stocks, obviously, Facebook, Amazon. Netflix isn't, I don't know, they're not as dominant as they once were. So I don't know if you can continue to throw them in there, but Amazon, Apple, Microsoft even, and Google, those are the ones that make up the FANG. So I think that's worth pointing out. If you dig a little bit deeper, it's not even across, we've had thousands and thousands of small businesses go out of business. People are losing their livelihoods, and all of that is while we're close to the top in the S&P and the Dow. So it's a little bit confusing, and rightfully so, for investors out there.
Well, and just to provide even more perspective, I don't know that you have end of quarter numbers yet, but as of a few days ago, the S&P 500 was only up a couple percent for the year. The Dow, of course, a much smaller market basket, was down about 4.5% for the year. And the Russell 2000, which is tracking small company stocks, was down 12% still year to date. And it's only the NASDAQ, following a lot of technology stocks, that's up 22%. But the real story is that bonds are up more than most of the stock indexes. I don't know if you want to talk about that a little bit.
Yeah, so it's out there that as interest rates fall, bond prices go up. As bond prices rise, your performance is going to look better on your statements at the end of the year. So we saw the Fed early on in the pandemic say, okay, we're going to put interest rates from wherever they were. They might have been around 1.5% at the time, down to the floor at 0%. So when that happens, that has a cascading effect across all bonds. If you remember back to April or May, there was some fear actually that a couple of the bond markets would collapse, and the Fed stepped in. They started buying ETFs. A small number of I think high-risk corporate debt as well, individual bonds for the high-risk corporate debt. So they really backstopped the bond market, and along with lowering interest rates, bonds have been performing really well this year. As we look ahead, I'm not sure that's going to continue much. Usually if we see, unless interest rates go negative, of course, that's the caveat here. And right. I don't think that's impossible. We've seen it in Japan and Europe over the past decades. So it could happen. But unless that does happen, I don't know if performance is going to be there long-term for bonds. And investors might be forced to look elsewhere, right? If we're not getting the same interest rates that we were, investors might be forced to look elsewhere in their portfolio, have to use the whole portfolio for income and appreciation.
Yeah, that's probably something we need to talk about more in an upcoming show. I want to say something about that in a minute, but just to give some perspective, at least as of in the last week, and again, these are moving targets, all these performance numbers I'm using, but the Fidelity US Bond Index was up 7% for the year. So keep in mind, that's better than everything except for the NASDAQ, really. And then the US Treasury Bond ETF was up 9%. I think this is really important because when you start to get your statements and you look at performance and you may be thinking, well, you expect to open your performance report and see, a positive return. We haven't even talked about international stocks, which are still down for the year, and emerging market stocks. So if you've got a well-diversified portfolio, you put that all back together and you've got several different indices or several different areas of your portfolio that are negative. You've got bonds that has a decent positive return, and maybe you're really well diversified and you're not overly heavy on technology stocks or what we would call growth style. Your returns are going to maybe be even, maybe slightly positive, maybe negative, depending on how aggressive you've been, how much international is in there. So I want to help people have reasonable expectations, because I think you can get really misled by the news around all that. So
What,
the
I
Go
was just going
ahead.
to jump in and say, that's great, Lisa. I'm a client, that's great. Why am I not only in growth stocks right now? We know they've been performing well for a long time. Why am I not only in that? Why am I holding these value stocks?
Right. And I know we were talking about this before the show. I mean, what we do know from much, much longer historical periods, that value style stocks, dividend paying, that tends to be, it tends to be your, pharmaceuticals, energy stocks, financials, tend to be the value style stocks, anything underperforming as well, but they're also paying a dividend, have outperformed growth style technology stocks. But there are periods when you look over the last, I don't know, it's like 20 or 30 years, there are periods of time where technology growth style has outperformed. And I think more recently, that's the trend we've seen. Investors tend to be shorter term focused. We know there's a bias around that, right? Recency bias. So you tend to think, well, isn't that where I should be invested? But what's the answer on that? What do we really believe? Is that the right thing to do, chasing returns?
Yeah, no. And I think it's worth looking back in history at those points in times, like the dot-com bubble. There was a long run-up of tech stocks outperforming the market. But then I think when the market was going through turmoil in 2001, 2002, value switched and that was leading the pack. And nobody knows when that's going to happen. There's no signals that pop up on your financial advisor's desk that says, okay, I'm going to put all my clients back in value at this point. Nobody knows when it's going to happen.
Yep.
So that's why I think diversification wins out. If you're a long-term investor, which most of our clients are long-term investors, they're in it for the long haul, not trying to make a quick buck, then diversification is an easy, there's a saying, there's no free lunch in investing. Diversification is your free lunch. That's the best way to invest for the long term.
Well, and as I was telling you before we started the show, I just read a headline today that said that it looks like for the third quarter that value may have started to outperform growth. We saw some pullback in technology stocks. And again, what you said at the very beginning of this discussion, technology is so heavily weighting the S&P 500 at this point. So when they pull back, that pulls everything back.
Yeah, and you might ask, is this the start of something new? There's no way to know. We'll be able to look back in a 3-month window from now, maybe that it was, but right now in the thick of it, we've seen, this year has been crazy for investors. From January to the end of March was down 34%. From March to about a couple of weeks ago in middle of September, I think we rallied 60%. And from then, we've had roughly a 10% correction with some volatility up and down along the way. So it's been a bumpy ride, and there's really no way to tell where things are heading as much as our clients and investors want want to think that it's easy to tell where things are going. I think nobody knows.
Yeah, and we're heading into a period, obviously pre-election, even post-election, where we're going to have a lot of volatility. Volatility, it's probably worth saying, I want to say this point and then go back to the chasing yield piece. Volatility can be down and up. So when we say volatility, we don't mean market's going to crash. We mean it's going to be like a roller coaster. And that's a very tricky time to be an investor and to try to guess, should I be in, should I be out? What we would say is that, it depends on your situation, it depends on your cash needs, it depends on your timeline to your goals, like retirement. But it's most of the time best to ride it out. When you try to second guess, should I get out? Should I wait on the sidelines? You talk about this all the time. That's decision number one. Decision number two is, when am I going to get back in? Because you can't afford to sit on the sidelines. You can't meet your goals unless you're saving boatloads of money by sitting on the sidelines. So
yeah. And as human beings, we're built really well for decision one, right? Like
right.
Amygdala goes, we're out of there. But decision two takes much more thought, and it's hard. It's really hard.
And one last thing that I'm starting to hear more about, and actually have been hearing with one of the endowments that I'm involved in with their investment committee and their professional managers, is this whole idea that, hey, if I'm not going to make very much yield on bonds because interest rates are so low, do I have to go looking other places? Do I have to go looking to stocks for growth and return? And that's something I want to unpack maybe more in an upcoming show, because I think you have to be really careful on that. I would hope that we would look in other sectors of the bond market before we go jumping to the stock market, because once you move from bonds to stock, you're picking up a different kind of risk.
And we do know also that there's diminishing returns the farther we go along on the stock allocation side, right? Like you're not going to go from 60 to 70% in stocks and pick up a lot more return. It's diminishing returns the more equity you have. It's absolutely important that you do, I think, have balance there, but there's some argument, even looking historically amongst academic people, of what's the best portfolio for clients in the long term. It's a shifting landscape, so I don't know if there's a good answer right now. You may end up having to search elsewhere for yield in the long run. I know there's no the interest free or the risk free rate. The risk free rate that gets quoted in investments is zero right now, or 0.6 or something like that. So you might be forced to look elsewhere than bonds.
I mean, I think the tricky part about that is that because of the economic backup that we've had here, there are plenty of companies cutting their dividends. So if you're chasing dividends, paying stocks because you're looking for income, and then the dividends are getting cut, and then your bonds are yielding less, I mean, this is actually a time where you don't want to be buying and locking in individual bonds, probably because they're going to be very low yielding. You may be better off in a diversified mutual fund or diversified portfolio of bonds, that has some high yield and other things like that. But you need to be careful. When you start chasing yield, it often takes you places that if the economy has a big shock, you're not going to want to be in. And so you have to, you may need to be patient. You may need to think differently about your income, and I put that in air quotes, needs, and solve for a different way so that you aren't taking too much risk at a time where there's already enough risk out there. So I think something we'll unpack a little bit more in the future.
Yeah, definitely. I think that's probably a good place to call it. I know if you've been watching this long, you're knee deep in the investment world. So hopefully you enjoyed the conversation. So thanks for checking in. Feel free to give us comments, likes, subscribe to our channels, our social media channels, check out our website, all that good stuff. And thanks for tuning in.
Hey, take care. Thanks.